So are you actually investing or are you just gambling with better charts? It's a serious question. Let's dive right into this explainer and clear up the massive, just pervasive confusion about what it actually means to put your money into the stock market. You know, a lot of people think they know exactly what they're doing the second they open up a brokerage account. But the reality? Well, a lot of folks are playing a game they simply don't fully understand yet.
Okay, so here is our roadmap for today. We're going to cover the great market misconception, defining the two contenders, technical versus fundamental analysis, mindset, time and risk, and finally, choosing your financial path. Let's get into it.
Part 1. The Great Market Misconception, Separating Action from Intent.
And that brings us right into Section 2, defining the two contenders in this battle of philosophies.
You see, a huge part of the misconception we just talked about is that people hit buy on a stock app and instantly, boom, they call themselves investors. But then the moment the price dips even a little, they completely panic and sell. That disconnect between what you intend to do and how you actually act is exactly why so many people end up losing their money. Trading is all about bringing in a limited amount of capital to generate short-term daily income. It's an intensely grueling job where you literally have to clock in right when the market opens. You're trying to scrape together small, frequent profits just to pay today's bills. Investing, though, entirely different universe. It's about planting your capital like a seed and just letting it compound into massive wealth over 5, 10, maybe 30 years. It's money that grows while you sleep. One is a highly active daily grind. The other is passive, long-term wealth creation. Now, this is absolutely crucial. Passive investors care deeply about something called intrinsic value. Basically, that's a company's true worth, completely ignoring whatever the flickering ticker price says on any given Tuesday. They want to know the business is actually innovating and creating real-world value. Traders, on the flip side, they often buy and sell massive blocks of shares without even knowing what the company actually makes. I mean, seriously, they don't care if the company makes revolutionary AI software or literally just cardboard boxes. They are simply surfing the psychological waves of human fear and greed that cause the price to jump around minute by minute. All right, moving into Section 3, Technical versus Fundamental Analysis, the tools of the trade.
So, with those core philosophies laid out, how do these two camps actually decide what to buy? Well, traders live in the fast and furious world of technical analysis. Just picture this, a trader glued to 3 flashing monitors, sweating over a 15-minute candlestick chart, where green means buyers are winning and red means sellers are taking over. They are desperately trying to outsmart the crowd. They scrutinize past price patterns and momentum, essentially trying to predict what millions of strangers are going to do in the next hour, or even the next 10 seconds, just to exploit a tiny window of volatility. On the other hand, investors rely on fundamental analysis. They aren't looking at squiggly lines on a chart. Actually, they're looking right under the hood at the actual engine of the business. They spend their time on screener websites, digging into balance sheets and cash flows. And why does that matter? Because they are asking the big, structural questions. Does this company actually have cash in the bank? Are their profit margins growing? If a massive recession hits tomorrow, will they survive? Because they are buying a literal piece of a business, they need to know it's healthy enough to absolutely thrive a decade from now.
Let's move on to Section 4, Mindset, Time, and Risk. Time for a reality check. Think of trading kind of like a frantic, adrenaline-pumping, limited overs cricket match, like a T20 or an ODI. It requires immediate, highly skilled, and incredibly high-risk hits. You have to score fast, the pressure is immense, and you are constantly on your toes reacting to every single delivery. Investing? That's your slow, methodical 5-day test match. It is built entirely on patience, determination, and a long-term strategy. You absolutely do not need to swing at every single ball. You just need to protect your wicket, avoid stupid risks, and let your score quietly, steadily build over time. And because trading is so insanely fast, you have to use a tool called a stop loss to automatically sell if a stock drops. It's meant to prevent a total disaster. But man, here is the agonizing trap that catches almost everyone. Imagine you buy a stock at $10. The price suddenly drops, hits your stop loss at $8, and automatically sells your position so you don't lose more. But then, and this happens all the time, almost immediately after you get bumped out, the stock rockets straight up to $17. You just permanently locked in a loss and had to sit on the sidelines while completely missing out on a massive wave of profit. It is soul-crushing.
And that brutal reality leads us straight to this number, 89%. 89% of traders actually lose money. Let that sink in for a second. Why is the failure rate so astronomical? Well, because day trading is the ultimate David versus Goliath scenario. You're a retail trader sitting at home, trying to play poker against industry professionals, multi-billion-dollar hedge funds, and institutional banks. And worse, you're competing against cutting-edge supercomputers executing thousands of highly optimized trades every single second. It is a mathematically ruthless environment.
So, if the odds are genuinely that terrible, why do millions of people still try? The legendary investor Warren Buffett hit the nail on the head here. He perfectly diagnosed this core human flaw. Nobody wants to get rich slowly. Human nature just intrinsically craves that immediate reward, right? We want that dopamine hit of a fast win. We all secretly want the massive lottery ticket payout today. But the mathematical, unsexy reality is that true generational wealth simply takes decades to mature. So let's look at what getting rich slowly actually looks like in real life. Let's say you bought 100 shares of Apple for roughly $300 back in 2008. And let's say you literally just forgot about it for 16 years. You resisted every single urge to tinker with it, sell it during a scary dip, or trade it for whatever the flashy new thing was. Do you know what that would be worth today? Around $22,000. The heavy lifting wasn't done by frantic daily clicking. It was done entirely by the staggering power of time, compound growth, and just sheer patience.
Plus, it gets better. Strong established companies, like our made-up WeWe shoes here, they don't just grow in share price, they also pay out regular dividends. That means you earn hard cash just for holding the stock. It's exactly like owning a rental house and collecting a steady rent check every single month, while the actual value of the house itself just keeps going up over the years. You are literally getting paid a cut of their profits just to sit there and wait.
Now, I know what you're thinking. Safe companies are boring? Absolutely not. Don't think investing in large, safe companies is slow and boring. A large-cap stock like Tata Steel delivered a staggering 500% return between 2020 and 2024. Safe doesn't mean stagnant. You can absolutely achieve life-changing, thrilling returns without the daily heart palpitations and the emotional roller coasters of day trading.
All right, Section 5, choosing your financial path, the final verdict.
So, after all that, which path actually makes sense for you? Just take a look at this matrix. Look at the time commitment alone. Trading requires 3 to 4 hours of intense, uninterrupted daily focus while the market is open. Investing, maybe a few hours a month to check on your portfolio. If you already have a demanding job, or you're a full-time student, or running a business, taking on the grueling daily stress of trading is just going to leave you pulling your hair out. Passive investing allows you to actually relax, protect your peace of mind, and just know your money is quietly working for you in the background.
However, I know some of you out there. If you're well capitalized, you have the dedicated time to learn the really complex technical skills, and you simply cannot resist the action of the market, maybe consider a hybrid approach. Basically, lock away 80% of your capital in safe long-term investments to protect your future. Then, use the remaining 20% to feed your need for action. This way, your core wealth is completely insulated from your high-risk trades.
As we wrap up this explainer today, I want to leave you with one final, super important question to ask yourself tonight. Are you entering the market just for the adrenaline rush of the game, or are you truly ready to build lasting wealth? Honestly, understanding your own psychology and your true intent is the very first and easily the most important investment you will ever make. Take that question with you today, think it over, and I'll catch you in the next explainer.